Off the back of the previous two videos, institutional entries part 1 and part 2, what I'm now going to dive a little bit deeper into is how we can really increase our risk reward. And we do this by actually entering on the lower time frame. Now, what we still have to do is we have to find out our structure, and we actually use the higher time frame for this. So whether that's the 4 hour or the 1 hour. For this, let's just say we're using the 4 hour. We find our structure, and for this example, I'm going to use an uptrend. And then what we do, we mark out our point of interest. So let's say we've got an institutional candle down here. There's some imbalance. We know that needs to get filled. And simply what we're waiting for is price to reach all the way down to this level. Now, when price does reach down to this level, what you can actually do, you can put an alert on this chart so that you don't have to watch the chart until price reaches down to this level. Now, when price is within your point of interest, what we do is we scale down onto the lower time frame, and the lower time frame can be the 15-minute, the 5-minute, 3-minute, or the 1-minute. And effectively, what you're looking for is a break of structure to the upside. So what price may look like as it comes down into that point of interest on the lower time frame. Let's say this is the 5-minute chart. This is what price can look like. It's creating lower highs, lower lows, lower highs. And effectively what we're looking for is a change in structure. So for example, this is on the 5-minute chart. This is the high that created the low on the 5-minute. And what we see here is we actually see a break of structure. And the way we can simply enter is wait for a retracement on the lower time frame, and then we simply just get in using the institutional area once again. And then we set a limit. For this example, it would be a buy limit, and then we'd move up. And simply, this is increasing the risk reward significantly using the same concepts. Now, the reason why this works is because price is fractal. The markets are fractal. So what happens on the daily, the 4-hour, and the 1-hour time frame will also happen on the 15-minute, the 5-minute, the 1-minute, and even like a 15-second chart. So we can apply the same sort of concepts to utilize them in a lower time frame. So to actually finish off this little example here, I will just effectively draw a little bit of a diagram here. Let's say something like that. And all we're waiting for is a retracement down into this little level here. And then we'd set a buy limit, stop loss below the low, and then we'd target it high. Now, as you can see from this little example here, this purple box is about half the size of this full candle box. Now, I know we're just on a line chart, but this is the actual case on the real charts. It tends to be that you will cut your stop loss in half or even by 2/3. And by doing that and having a logical reason to do so, you can then actually increase your risk reward. So for example, if I was to have the stop loss below the low on the full institutional candle, we can see we've got a 1 to 6 here. Now, if I was to move that down to this area and put the stop loss below the low on there, now we have a 1 to 12. Okay, so we've literally doubled our risk reward just by waiting on the lower time frame for a change in structure. Now, the same thing does apply if we are selling. So let's say we've got our down movement, we've got an up movement, and actually this time I'm going to do a bit of the equal high example. So we've got the equal highs, we have a raid of those equal highs, then we have a move down, and then we have a move up into our point of interest. Now, at this point, we can identify this potential institutional candle here, the up candle before the down move, and the up candle that run these highs. And normally what we'd do, we'd put our sell limit here with a stop loss above the high, and we target the low. But instead, what we'll do is we'll have an alert set on this. And what we'll do, we will wait for a break of structure. So we'll wait for a high to be created, then potentially a low, maybe a higher high, and then we'll wait for the break of this structure. So the low that created the high on the lower time frame. Then all we'll do is we'll wait for a return to this candle, much like we're waiting for a return to this candle on the high time frame, except this is on the lower time frame. This will be on the 5-minute, the 15-minute, or the 1-minute. And then all we're simply doing is we'll put a limit at this level. So for example, last up candle before the down move that broke this structure, Same rule applies. Sell limit, stops up there, and then target the low. Now, instead of it being 1 to 6, we've now got a 1 to 16 potential. And this is how we can really make the stop losses smaller. We can increase our risk reward. But also, this area of price here acts as an extra confirmation. So if this already wasn't enough of a confirmation for you, we now have an extra confirmation and we can get in with the momentum change. Okay, so let's actually now have a look at a live market example. So as you can see here, we have a chart of USD CAD on the 4-hour. Now, if I'm analyzing this properly, I can see we've got a break of structure to the downside. We can see that we have a candle close below this previous low. And all we're doing is we're waiting for the retracement up to our institutional area. Now, what can we see about our institutional area? Well, we can actually see our institutional area has taken out of this high. So we've got a stop run, we've got a run below, we've broken this structure, and now we're looking at our 4-hour point of interest. So if I just mark this one out, and all we're simply doing is waiting on the lower time frame, what we can do is we can go down to the lower time frame. We can actually see that we actually have our imbalance fill at this level. So this is a very logical place for us to be looking for a break of structure on the lower time frame and then to gain entry. Now, if I was to just put my sell limit at the open of this 4-hour candle, and then I was to target the low, as you can see, the risk reward is absolutely horrendous. We've only got a 1 to 2. But what I'm going to show you now, I'm just going to hop over to the lower time frame. And for this, we are using the 3-minute. And we can see we've pretty much got our imbalance fill. And what we're starting to do now is we're starting to break structure on the lower time frame. So let's just analyze this a little bit. We have price moving up, got a low. We're just analyzing this. As you can see, each of these lows and highs are higher than the other. Then we have this one that's created. And at this point, our important low that price needs to break is this one here, because this is the low that created this high. Now we can see that price has broken that. So all we're waiting for is a retracement up into hit this candle, and then we'll put the stop loss above the high, and then we'll target the low. So whereas our last up candle before the down move that breaks structure. So what we can actually see is we've got our break of structure here, which is this low. And then we can see this is our last up candle before the down move that's broken this structure. So all I'm going to do, I'm going to use a rectangle box, and I'm just going to move that out. And what we would do in this scenario is we would put a sell limit at this level where the wick is, and then we'd simply just have our stops just above the high. And our original target was the low on the 4-hour time frame, because if we are creating lower highs and lower lows, we can expect to create a new lower low after creating this lower high. So now we can just play price out. See, we tap into this level. And then from here, we can drop. And what's so great about this is, if you remember, the risk reward before was, it was a 1 to 2. And that was with a 70 pip stop loss using the entire 4-hour candle. Now, all we've simply done is just waited for the break of structure on the lower time frame, and we've eliminated the need for having such a big stop loss. We have a logical reason why, and now actually, as you can see, we are running a 1 to 22. Okay, I'm not saying that this will work all of the time, but it certainly will increase your risk reward. And with an increased risk reward, it means your win rate needs to be significantly less in order to make good profit. Now, if I just move this onto a higher time frame, it'll just run a little bit quicker. I'll move on to the 1 hour. Perfect. Move that onto the 1 hour and just run price a little bit quicker. And boom, there's take profit. Now, within this area, notice how I mentioned that you can use the last up candle before the down move. What you can actually do to refine that even further is you can use the open of the last up candle before the down move. So if we use the open on this, let me just zoom in a little bit, the open of this last up candle, which is here. So if I just mark out the open, you can see we actually reduce the stop loss even further. So now our stop loss, instead of being 8 pips, it is now 6.2 pips. And now we have a 1 to 27. So you can see with these small refinements and just waiting on the lower time frame for the breaks of structure, we can increase our risk to reward significantly. And we can also eliminate the need to have such a good win rate. So I hope you now understand the power of entering on the lower time frame and how we can get some insane risk reward like this 1 to 27 here on screen. And what I want you to simply do is look at where price reverses and then start to backtest the lower time frames. Now, I will upload a video on how to backtest if you do not already know how to backtest. And from there, you'll be able to refine this strategy and understand it to a level where you can go execute it on the market live. One thing to note is as you do trade this, when you're using such a small stop loss, you do need to have a specific brokerage account called a RAW account. And effectively what this is it has minimal spreads, which will allow you to execute trades with such small stop losses. So I hope this video helped, and on to the next one.